Hi, so I wanted to make a quick video covering fixed income securities and bonds to help you guys with your upcoming fixed income assignment. Some of this is going to be review from your Principles of Finance courses, but hopefully some of it is new and some of it is helpful to you as you make your way through the assignment. If you have any questions, please definitely do email me. And with that, I'm going to get started with the value of bonds. We're also going to go over the yield curve, default risk, as well as how this actually works in practice, which I think is really important for you guys to know. So as a review, bond value is determined by the present value of coupons. Coupons are kind of like dividends from stocks. Coupons are checks that you get every 6 months or so as basically call it a thank you for holding the bond. It's a way of getting a return stream without actually having to go all the way through to the end of the term where a bond investor gets back their par value at the very, very end. You do have zero coupon bonds that don't pay coupons, but a lot of bonds, specifically corporate bonds, will pay a coupon as a way of getting cash into the hands of investors without them having to wait to the end of the term. The other component, like I mentioned, was the present value of the par, which gets discounted back all the way to the present to help derive the value of the bond. This is the formula. Right down here, this rate of return, this is your yield to maturity. So the percentage rate of return that gets basically the two sides to equal, the price is going to equal all the coupons plus the par value, all brought back to the present value. The yield to maturity is going to be this mathematically. So then the question is, so what goes into determining a yield to maturity? What goes into that required risk calculation? Well, there's a couple of things. One is going to be the nominal risk-free rate, which I will discuss at the end. But probably the two more important in terms of the textbook is going to be time and default risk. So we're going to start with time, which is measured by the yield curve. So the yield curve is a graph that shows yield to maturity as a function of maturity, holding default risk constant. So generally we measure this as the AAA, which I'll get into what AAAs are, but essentially that the ultra risk-free securities, we generally measure this as the AAA or the US Treasury yield curve. Is the kind of the purest ones that are generally used because they have the least amount of noise when it comes to default risk. So we use kind of a AAA yield curve that graphs the yield to maturity of AAA bonds as a function of time. They're generally upward sloping. It generally looks like this. So now the question kind of becomes in a lot of your heads, well, why is it generally upward sloping? Well, there's two theories that explain why it's generally upward sloping. By upward sloping, I mean the yield to maturity of a further out issuance bond or a 30-year bond versus a 1-year bond, that forms an upward slope. When I graph it mathematically, that is an upward sloping yield curve. So there's a couple theories as to why the yield curve is generally upward sloping. One, the expectation theory that yields to maturity are determined solely by expectations of short-term yields and rates. What does that mean? Essentially, the current rate for the 1 year is going to be made up of the current expectation for the rate for the next 6 months and the rate for the following 6 months, right, from month 7 through 12. Generally, the expectation is that interest rates may be rising, or that there's going to be more risk going into the as you go further and further into the future, and therefore investors want to be compensated, which gets us into the liquidity preference theory, which states just that investors demand a risk premium on long-term bonds relative to short-term bonds to compensate them for the longevity of the deferred consumption that they could do now. Also, there's risk inherent in delaying things further. If I tell someone that I'm going to pay them back $10 tomorrow, there's a lot less risk of that, me actually being able to pay them $10 if they know that I have it, than if I wait a year. Oh, I'll pay you $10 in a year. I could do all kinds of things. I could, buy a bus within the next year, or the corporate version of that, I could go bankrupt in the next year. There's a lot more risk versus a one-day transaction. investors are going to want to be compensated for that. So these are the two theories. They're not either or, but they're probably both true to a degree, and they really do kind of explain why the yield curve shapes the way that it does. During a period where there is upcoming kind of concern over economic conditions, during periods of economic uncertainty, the Federal Reserve generally lowers interest rates, which can then cause, if the market is expecting that the Fed will lower interest rates using the expectations theory, I may think that a recession is 2 years out. Well, this can create some really weird looking yield curves, some of which are downward sloping, because while the interest rates now, between now and 1 year, are high, if the Fed then cuts interest rates to practically zero, this period may be high, let's call it like 2%. But if they then cut interest rates to zero during year 1 and 2, similar to this example, my actual spot rate for the 2-year is going to be close to 1. Fit this in. It's going to be approximately 1% is my spot rate, even though my 1-year interest rate is that 2%. That's 2. That's 1 because they cut interest rates to 0 during the 1 to 2 year portion of the yield curve. That's going to cause some downward sloping. That's why it does invert at times when there's great uncertainty. That's probably more than you needed to know about the yield curve, but I hope it does explain a lot of market characteristics. The other component of this in the real world is default risk. Bond default risk is measured by rating agencies such as Moody's, Standard & Poor's, and Fitch. Basically, they give ratings that tell you how great of a probability default is. In investment grade bonds, this is AAA, AA, A, BBB. These are investment grade. These are high quality securities. The default risk is minimal. In high yield or junk bonds, the default risk is much higher. Investors demand a premium for high credit risk or high default risk, and this is measured by the credit spread, which is the spread above, say, we have BBB bond yield to maturity. We have the risk-free rate yield to maturity for the same time period, plus the credit spread. That's the math. This is the measure of how much more yield to maturity do investors demand for a BBB bond versus the risk-free rate. There is a credit spread for every rating. The further down you go, the higher the credit spread goes. So the credit spread on a AA is going to be lower than the yield than the credit spread of a BBB. It's going to be lower than that of a BB. These are going to be generally rising. So the credit spread on this, maybe let's call it 1%. This one's going to be 1.5. This one's going to be 2, so on and so forth going down. The more risk, the higher the credit spread. So how does this all then work together? Well, when I'm going to issue a bond, the market yield to maturity is going to be dictated by the nominal risk-free rate, generally set by the Federal Open Market Committee, or FOMC, generally proxied by the federal funds rate, which is the ultra short-term lending rate. Let's call that 2.5% for our example. We're then going to have to add on top of that basically a premium for whatever the term that I'm going to be issuing my bond at. Let's use it for this example. I'm issuing a 5-year bond. The Treasury yield curve is upward sloping. Currently, the Treasury or the AAA rate is at 5% for 5 years, and the short-term rate is at 2.5%. Subtracting those two, I get my 2.5 adjustment for the yield curve. As I go further out, this would go up. I also then have my credit spread. Let's say right now the credit spreads for BBB bonds, the rating on me is a BBB bond. For this example, I'm going to add another 1.5% to the yield to maturity. I add all this up, 2.5, 2.5, 2.5, 2.5, 1.5, I get 6.5%. Then depending upon the coupon rate and whatever my par value is, I can then discount back to price the bond that I ultimately issue. That's how it works. You basically have these three inputs, you add them together to get the yield to maturity required for a bond. You then use the yield to maturity to price your security in terms of the issuance. This is also how it works and why bond prices are constantly changing in the real world. You constantly have nominal risk-free rate changing. This is about every 6 weeks. In terms of the stated Fed funds rate by the FOMC, these two change all the time. Yield curves, depending on whether or not the economy is getting better. If it's getting better, it's going to be steepening. If it's looking like it's going down, it's going to be flattening or ultimately inverting. So the premium that the yield curve imposes is going to be changing all the time, as is credit spreads. During periods where people want quality securities, it's going to require more and more spread or more premium to get investors to leave quality securities and go into more and more junky or risky securities. So during periods where investors are flying to quality, credit spreads are going to blow out or go up. During periods where it's called a risk-on environment, investors are willing to bear risk because they think it's opportunistic. Credit spreads are going to be going down. There is an inverse relationship going back to the very beginning with bond values. There is an inverse relationship between the price of a bond and the yield to maturity. So if credit spreads are blowing out, the yield to maturity is going up. So spreads are going up, yield to maturity is going up, price is going to go down. There's an inverse relationship between yield to maturity and the value of a bond. And this is what causes bond prices to move in real time, is changes in either the nominal risk-free rates, the yield curve flattening or steepening, or credit spreads changing on a minute-by-minute basis. This is what causes the fluctuations. This is how it actually works. This is also a lot of the terms that are covered in your book. So hopefully you found this helpful. If there are any questions, please email me. As a reminder, this is the week where you have your fixed income project due. Let me know if there are any questions. Hope this helps. Thanks. Bye.